In the beginning, I gave you few examples of business transactions. For example, purchase of goods, sale of goods. Every business transaction has dual effect on business, also known as duality concept. I will do a series of examples with you and I will show how every transaction has a double effect. So let's start with the first example. Day 1. Owner puts 10,000 in cash to start a business. To make things simpler, I would say what business owns and what business owes. So let's change the color to black. Okay, so business has received 10,000 in cash. So the first effect is that cash is increased by 10,000 and cash goes under the heading of assets. Is there any effect on liability? No. On capital, yes, because 10,000 is introduced into the business as capital. So the second effect is that capital has increased by 10,000. Let's see it the other way. What is the accounting equation? Asset is equal to liabilities plus capital. So what has happened here is asset is now 10,000 cash. Liabilities, is there any effect on liability? No. And capital has been introduced, how much? 10,000. So we know that asset is always equal to liabilities plus capital. So it's fine. So this side is equal to this side. Now moving to day 2. Buy a property for 2,000 cash. Again, what business owns and what business owes to owner or to someone else. Now, buy a property for 2,000 cash. Let's see the effect on assets. Now there is a new asset, property, and how much is that? 2,000. So property has increased by 2,000, and what was used to buy this property? Cash. So is cash the same now? No. How much was the cash before? 10,000, and it is decreased by 2,000. And it makes it 8,000. Is there any effect on liability? No, because property was bought on cash and capital will still remain same as 10,000. So what's the dual effect of this transaction? Property has increased by 2,000 and cash has been decreased by 2,000. So day 3. Buys inventory on cash, $1,000. So coming to assets, property would still remain same. How much was it? $2,000. Now there is a new asset and that is inventory. And how much is that? 1,000. So $1,000. And cash, how much was it? 8,000. And is there any effect on cash? Yes, because inventory was bought on cash, not on credit. So 8,000 minus 1,000 makes it 7,000. A total of 10,000. Capital would remain same and it was 10,000. So So the two effects is inventory has gone up by 1,000 and cash has gone down by 1,000. This is the dual effect. Day 4. Buys inventory on credit 3,000. So let's see. Under the assets heading, property will remain same. There are no changes in property, so it will still be 2,000. Inventory, how much was it before? Let's see, it was 1,000. It was 1,000. So inventory has gone up by 3,000 and it was bought on credit. 1,000 plus 3,000, that's the first effect. New inventory is now $4,000. Cash was 7,000. But was inventory bought on cash? No. So there will be no changes in cash as well. So cash would remain same as 7,000. But what has changed here? Is there any liability? Yes. There would be a payable because it is the money owed to supplier now. Inventory wasn't bought on cash, so this is amount still payable. And how much is that? 3,000. Capital would remain same. There are no changes in capital. Capital is 10,000. So 13,000 and 13,000. So the dual effect of this transaction is inventory has gone up by 3,000 and payable has gone up by 3,000. What else is different in this example is now the business does not owe only to the owner of the business but to someone else as well. This capital was what business owed to the owner of the business, and now this is what business owes to someone else, and in this case it is supplier. Moving to day 5. Buys motor vehicle $2,000 cash. So property, how much was it? $2,000. There is no change in property, but now there is a new non-current asset, and that is a motor vehicle. And how much is that? Is 2,000 as well. Is there any change in the non-current asset inventory? No, it's still the same. And how much was it? 4,000. Okay, but cash was 7,000, out of which 2,000 is now used to buy motor vehicles. So cash has gone down by 2,000, which makes it 5,000. A total of 13,000 on this side. This is what business owns. So let's see what business owes. Capital. Business owes to the owner still the same amount, 10,000. There is no change. And to someone else, it's still the same. And how much is that? 3,000. Still the same. So this side would be equal to this side. So now we'll see the dual effect. Motor vehicle, that has gone up by 2,000 and cash has gone down by 2,000. Okay, so day 6 now. Sell half of the goods on cash, $3,000. It means half of the inventory, whatever it was, half of the inventory is sold for $3,000 cash. Now let's see the accounting treatment. I will start with non-current assets first. So property, there is no effect in property and it will remain same, 2,000. Motor vehicle, it will remain same as well, 2,000. Now inventory, it was 4,000 before, but now what has happened, half of it is sold for cash, $3,000. So half of the inventory is sold now. And what is half of 4,000? It is 2,000. So remaining inventory is 2,000 as well. Now cash. Inventory has decreased, but what has happened to cash? Cash is received. How much? $3,000. So it was 5,000 before, now 3,000. Cash has gone up by 3,000, so it's $8,000. Now you must have noticed something. Inventory cost $2,000 is sold for $3,000. So what is this $1,000? It is profit. And where will this profit go? Now let's see. In this section we had capital, so let's write it as original capital. How much was it? Original capital was 10,000. Payable, how much was it? Payable was 3,000. Okay, but where this profit will go now? What increases capital? Remember, I told you what increases capital and what decreases capital. So profit increases capital. It will go here, 1,000. So this figure here, 11,000. This 11,000 is what? Now this is the amount owed to owner, and payable is the amount owed to someone else and supplier in this case. So 14,000, and this side will be equal to this side. Now let's check it. I will make a profit and loss extract. It's so annoying, this voice. Oh my gosh, I should change my pen. Okay, profit and loss extract. Sales, how much was it? Remember I told you we will record the sales on cash or on credit, whatever it is, and in this case it's cash. How much? 3,000. So sale 3,000. And what is less? Cost of sales. And what was cost of sales? Cost of sales is 2,000 this here. So 1,000 is gross profit. 1,000. And this is this 1,000 here. This 1,000 here. Okay. So we have checked it now, and I have showed you how we calculated this 1,000. So the overall effect on this accounting transaction is cash has gone up by 3,000. Inventory gone down by how much? 2,000. And what was the remaining 1,000? It's profit. recorded how much? 1,000. So that's the effect of this accounting transaction. Now let's look at the next example. Day 7, sell the remaining goods on credit $5,000. So it means that whatever stock was left, whatever inventory was there, it's now sold. Not on cash, but on credit $5,000. It means money is to be received in future by our customer, by business's customer. So let's look at the accounting treatment, starting with non-current assets first. Property. Is there any change in property? No, and it will be 2,000. Motor vehicle, no change, 2,000 as well. Moving to current assets, inventory. Yes. Sell remaining goods means all of the inventory is sold. Initially it was 4,000, then it was reduced to 2,000 because some inventory was sold for cash. But now the remaining is sold as well. So 2,000 minus 2,000 and it's nil. Cash. Is there any effect on cash? No, because it is sold on credit, not on cash. So cash will remain same, 8,000. But now there is a new current asset, and that is receivable. And how much is the receivable? It's 5,000, because 5,000 is the amount owed by the customer to business. So what amount is to be received in future is 5,000. So inventory has gone down and the amount to be receivable has gone up by 5,000. Now one thing you might have noticed again, inventory cost 2,000 is sold for 5,000. So what is this 3,000? It's profit, and let's see where it will go. Capital, original capital. Let's write it original. How much was it? 10,000. Payable, no effect. 3,000. Profit, how much was it before? It was 1,000 before, and now what has happened? Profit has gone up. How much? 2,000 of inventory was sold for 5,000, so 3,000 profit. So a total of 4,000. How much is? It is 17,000. And this amount would be equal to this amount here. Now, this 14,000 here is the new amount business owes to the owner of the business, 14,000. Now let's check this 4,000. Let's make a profit and loss extract. Sales. I will calculate the total profit now. Sales. How much was the sales? First, let's look at the previous example. It was 3,000 and now it's 5,000. So sales total of 8,000. So it's the total sales revenue, cash and credit. Cost of sales. Let's look at the previous example. It was 2,000 and now 2,000. So 2,000 plus 2,000. 4,000. So how much is the profit? Gross profit. Gross profit. Its total gross profit is 4,000, and this is the figure over here, 4,000. So we have proved that it is correct. Okay, moving to next example. On day 8, business has paid the supplier $1,000. So let's look at it. What business owns and what business owes. Okay. So property will still be the same, and it was 2,000. Motor vehicle was 2,000 as well. Inventory was 0, so I'm not writing it here. Receivables were 5,000, and cash business owns is 8,000 minus 1,000, because business has paid now. So cash has decreased by 1,000, which makes it 7,000. A total of 16,000. This is what business owns. Now let's look at what business owes. What was the original capital? 10,000. Original capital was $10,000. Profit was 4,000, and 14,000 was what business owes to the owner of the business. Payable. Now business has paid its supplier. Business owed 3,000 before, but now what has happened? Business has paid 1,000 out of it, so now it has to pay only 2,000 in future. So 16,000 in total, and this amount will be equal to this amount. And so the dual effect is that cash has decreased by 1,000 and payables has also decreased by 1,000. Now moving to the next example. Day 9. Business pays rent $500. Okay, so starting with non-current assets, property will still be the same, 2,000. Motor vehicle, same, 2,000. Receivables, same, no effect on receivables, 5,000. Cash. Now business has paid $500 rent. So cash has gone down by 500. 7,000 minus 500 would be 6,500. And if I do the calculation, it is 65222. It's 15,500 if I'm not wrong. Okay, moving to what business owes. What was the original capital? 10,000, and what increased that capital was profit. But now look at it. Business has paid rent. It's an expense. So expense has increased. Will that affect profit? Definitely. Profit, because the final profit will go down because of this expense. It will reduce the profit. So profit was 4,000 minus, we will check this also, and now the profit will be 3,500. Payable was now, the new payable was 2,000 and it is 15,500. So now I will check this amount here, 3,500. So let's move to the profit and loss extract and let's check out sales. The total sales revenue, credit and cash, both credit and cash, as done in the previous example, it was 3,000 in cash and 5,000 on credit, which was 8,000 in total. Cost of sales, as we did, no change, would be 4,000, and gross profit was 4,000. Okay, but is this the final profit? No, because what we saw in the pro forma as well, that there are expenses incurred by the business which decreases this gross profit. So rent, less expenses, and what's that expense now? In this case it's rent and it's 500. So 3,500 is net profit, and this is the final profit as well, 3,500. So this figure, it has been proved that this figure is correct. So the dual effect is that cash has decreased by $500 and profit has also decreased by $500.